Hello, everyone, and welcome back to the Mastering Commercial Real Estate podcast. I'm your host, Corey Mortensen, and today we'll be diving into the latest trends and insights from the multifamily and commercial real estate sector nationally and in Texas. So first of all, I'm going to give the insight that I have discovered from scraping the top 23 market reports that I could get my hands on and analyzing the data to bring a quick summary. I don't want to run over all of the details of each one of those reports on a podcast because that would be pretty bland, but I wanted to give some of the highlights, and I will actually attach a link to this broadcast that has the summaries and the links to all of those reports so that you can look at them yourself. All the top sites, all the top research centers, I was able to pull and analyze those. So let's get started. So first up, a quick look back at 2022 reveals a year of resilience for multifamily real estate despite rise in vacancy rates. The sector saw a robust 26% increase in average effective rents. Now, looking ahead, the outlook remains optimistic, bolstered by a persistent housing shortage, but we'll see some things that are coming up, and I'm going to actually go into my own perception of what is happening. What I'm seeing, a lot of these reports, a lot of these marketing and insights and research reports that we took and analyzed are based on corporate commercial real estate, institutional real estate, and then I'm going to give my personal feedback for private equity, the solo investor, the boots on the ground, not institutional investor, what we're seeing actively in the market, because a lot of this is based on what's reported, right? Not what people are seeing day to day in real time. A lot of this has a lag factor, but I want to make sure that you guys are getting a lot of value for seeing a market report, hearing about the market report, hearing about what's happening. And I want to give both a national outlook, but also a more focused outlook on what the investors are going through. And you can hear that in the discussions from past guests. So please tune into those as well. But in the investment climate, the multifamily sector's price appreciation during the pandemic was noteworthy, but as we stepped into 2023, the delivery of an unprecedented 400,000 new units created both challenges and opportunities for investors. We've seen a huge pipeline of construction, record construction for new units coming to the market in 2023 and slated for 2024. The National Multifamily Index for 2023, the Sunbelt market continues to shine thanks to in-migration and other positive factors. However, the Northeast and Midwest are still playing catch-up, hindered by slower population growth and low construction activity, as I referenced. The economy has bounced back from COVID-19, but not without its share of challenges, including high inflation, potential shift in employment trends, talking about work from home. This economic landscape is definitely something to watch closely. The apartment sector itself is recalibrating. Factors like inflation and interest rate hikes are influential, but the long-term outlook remains positive, driven by demographic shifts and barriers to home ownership. In the rental market, cities that saw skyrocketing rents during the pandemic are now experiencing more significant changes in rent growth. Affordable housing is becoming a key focus area in addressing the ongoing housing shortages. Despite a cautious lending environment, multifamily investments are still attractive. The combination of high inflation and a structural housing shortage is creating a unique opportunity for investors. We're also seeing a widening gap between home ownership and renting costs. This shift is altering housing preferences, with more people, particularly millennials and Gen Z, leaning towards renting. And finally, the pandemic-induced demand has led to an increase in development, potentially creating a short-term oversupply in certain markets. However, strong population growth trends among young adults are expected to absorb these new units in the long run. Where that ends our national portion, and I'm going to go into my insights on what I'm seeing in the market. But to kind of close on that and give a summary of what we just discussed, there's a lot of construction coming through and the demand is going to be shifted from where we've seen in the last 5 years in the pandemic pop with huge demands and huge price appreciation. Now things are really coming down, really stabilizing, and the trends are moving away from call it the American dream of owning a home, because it has just become so expensive. Everything, inflation, home prices, food prices, gas. I mean, everything is double, if not triple, what it was prior to 2020. And people are moving to the mindset of renting because it's significantly more affordable. And everything has become more expensive, but wage growth is still struggling. And a lot of the reports that I have summaries for in our report that I mentioned earlier that you can go and check in on mentions a lot of these macroeconomic trends for employment and where things are going. Recently, we just saw the Fed, they did not announce another rate hike. We're at record high rate hikes, or rate for where we are in the market currently from where things have been. We went from 2% interest all the way up to 5% interest at the base. And now we're going to see, if you went out to get a loan on an apartment complex right now, stabilize, you're going to see, 6-7%. If you need bridge debt, close to 10. I mean, the interest rates are really, really high. And so this brings me to what I am seeing in the market and what we're working on and what we've gotten in feedback from brokers, owners, sellers, everybody. And so what we've been seeing most recently is the cap rates are decompressing. They, especially for C class, B class, A class is still a little more resilient. They still want that institutional money is still there, but for the tranche of investment money that is waiting, and there is a lot of dry powder on the sidelines right now waiting to be deployed. And in the last year, we've been making a ton of offers, and all of them have been accurate in their pricing structure and their valuation for the property. Everything has just been so overpriced. Even with the high interest rates, it has taken 6 months for sellers to start moving towards buyers' expectations of where the market actually is. There were transactions happening and people were buying on these lower cap rates, on these higher valuations. I think that they're going to be in trouble, especially with where the interest rates are. When they closed on it, maybe they got assumable, maybe that helped them out. And most people don't require the high yield that our shop does as a syndication shop. We look for high teens, 20+% returns in order to go out and raise capital. So that's also a limiting factor for us. But overall, now that there has been a very, very slow summer, by and large, the feedback from my friends at brokerages and the people that we work with at the brokerages have said that transaction volume was very, very slow, and the offers were coming in much, much lower than the original pricing expectation, whether that be from the seller themselves and the brokers took it to get the listing, or the brokers were just that optimistic on the pricing. Whatever it was, what we're seeing now in the last months is that prices are finally coming down in the tune of $1 million price reductions on some of these listings, which is significant. We're looking at deal sizes anywhere from 2 million all the way up to 10 million. And sometimes we'll look at the odd institutional size deal going much larger than that. And so to see $1 million reductions on a $7 million deal, that's quite significant. We're still a little bit ways off, but we're moving in the right direction. I've analyzed well over 100 properties just in the last 9 months. And all of those I hardly even needed to run the analysis because I was pretty much 30% off of the broker pricing every time for our strike price. And that's just to get to a 15% IRR, which is going to be tough to go out and raise money. Using accurate numbers, obviously we project that if we underwrite for 15, we'll probably end up around, 17, 18 during actual management should we strike at that price. But not to get too into that, there is still a significant way to go, but things are moving in the right direction, which is a huge development for the commercial real estate investor who is looking for deals, hasn't bought a deal in a long time, hasn't seen anything pencil, and knows how to value this real estate like we do. The other thing that we're seeing and that we're underwriting for is a decrease or a lack of appreciation in income and rent growth. We've seen by and large that the market for rentals is coming down to the tune of 2, 3, 4, 5%, depending on where you're looking in the apartment rents. Sometimes, for example, Austin is experiencing a much larger decrease in rent growth. San Antonio's probably around 2 or 3% negative rent growth year over year, month over month. And Austin is closer to 10, maybe even 15%, depending on where you take your measurement. But things are coming down, and that is killer for operators who are looking to do value add, going to raise money, running their business plan. If you are underwriting for exponential rent growth every single year, I just don't think you're going to have it. You're definitely not going to have it in year. We're not underwriting for rent growth in year one. We're underwriting for very minimal rent growth in year two, and then modest rent growth throughout the rest of the timeline. We may dip up and down. We expect pops here, decreases there, hoping that the pops upward outweigh the decreases. But these are things that we need to be careful for. You need to be careful for when looking at these deals. And it's evident that the incomes are going down. It may be a while before they bounce back. It may turn around in the next 6 months. We'll see how the spring the spring shows us, because I feel like that's a very telling part of the year. The other thing that's really hindering operators is insurance costs. If you're on the East Coast, if you're in Florida, if you're in hurricane storm prone areas, your insurance costs are astronomical. I mean, a deal cannot pencil with some of these insurance costs that they're looking at. Texas is not nearly as bad, but it's still very bad. It kills a lot of deals. You're not going to get these 500 a unit, 600 a unit. We're underwriting at about $900 per unit for insurance. And that may go up depending on what the property is. We're looking at C class, B class usually, so a little bit on the higher end, but insurance is leading the way in expenses, top of the expenses. Last thing on our mind and last thing that we want is another war in the Middle East. And I'm not going to go too into this, but that is something that's on the table very recently with everything happening in the Middle East. There is a potential for war to break out, and that's going to have an effect on the commercial real estate sector. That's going to have an effect on investor sentiment. So that's something to keep an eye on. Another thing is the construction. We touched on that earlier. We've got record number of construction that may lead to an oversupply, which would further exacerbate rental amount decreases. We touched on cap rate decompression. That is something that is going to be extremely key in your underwriting to make sure that your going out cap rate, your exit cap rate, is accurate. I don't know what that looks like in terms of your business plan, whether to keep the going in cap rate the same as the exit cap rate. Where do we see everything in 5 years? Where do we see things in 3 years, 7 years, 10 years? It could go a lot of different ways. I don't think that we're going to get crazy cap rate decompression or compression, in order to boost the values to get that appreciation like we've seen. So we're keeping things extremely modest and maybe even accounting for some decompression, some expansion in those cap rates. Interest rate expectations, definitely looking like and sounding like we're going to get some interest rate decreases in the next year and a half, which would definitely spur more demand, spur more investor acquisitions, investment sales. That's going to start to move the capital off of the sidelines. There's so much, like I said, dry powder on the sideline just waiting to be put into something that is going to generate a generous return like commercial real estate. I think investors are going to need to manage their expectations in that they don't expect to get returns, one, as quickly, and two, as high as they have with a lot of the real estate deals that they got in the last 3 years, because that appreciation is just not going to happen. That rental appreciation is not going to happen. That cap rate compression is not going to happen. You have to underwrite pre-pandemic style everything. If you draw a line essentially on every graph I've looked at, 2019, early 2020, pre-pandemic, you see the graph, it's going up, steady, up, steady, up, steady. And then you've got the pandemic pop, just a complete skyrocket up. Now things are coming mountain style back down. And you can pretty much draw a line from pre-pandemic to where things are now. Now, how much lower that's going to go, we'll see. The interest rates are going to play a part. Macroeconomic events are going to play a part. But basically, we're drawing a line from pre-pandemic valuations to now. The risk-adjusted returns, the Treasury is at, one of the highest points it's been in a long, long time. You can get a risk-free Treasury for around 5% plus or minus right now. That's your risk-free rate. That's an extremely high rate. I mean, you can open a savings account for 5% and put your money there, which is a great return, beating inflation. I mean, inflation they were fighting was, in the teens, very high, high tens. And now we've got monthly inflation just reported at 0. Seems like things are getting under control on that end. So these CDs that you can get, these treasuries that you can get for 5%, you've got to get a return that is significantly higher than that in order to get your risk adjusted return and entice investors. And think that risk adjusted premium, that risk premium to put on top of commercial real estate is going to be adjusting quite a bit in the next 6 months. But AI, prop tech, those are huge developments in the sector that we're seeing. Lots of advancement, ChatGPT and all of the tools, all of the plugins using AI right now in the prop tech sector are, I think, going to make some headway. Real estate's very slow to adopt, so we'll see how quickly they come into adopting these things. But we're actively looking at those avenues, those ways of managing leases, vetting tenants. That's a popular one for a lot of operators. Looking at and analyzing properties and helping with data entry. There's a million applications for this, and I'm excited to see where that space goes. So these are things that could potentially change the investment landscape and at least the operating landscape for commercial real estate investors. The outlook on recession is, they've been screaming recession for a couple of years now. And until recently, things haven't really appeared that way. It's pretty much, in my opinion, been forced by the interest rates and that lag effect with real estate in coming to price in those interest rates and accommodate them is taking a little bit. But the way that we're seeing unemployment and these other macroeconomic trends, I'll wait until the new year to see how things shake out. But I think that we're going to still be in recession style, just trickling very slowly through the first quarter, maybe the second quarter of next year. So to summarize and to give my outlook on commercial real estate in the private equity sector, which we're operating in, I think things are going to continue to go down. There's a lot of debt out there that's expiring. There's a lot of syndicators and a lot of operators that are exposed to much, much higher interest rates that they did not account for in their underwriting when they bought 1, 2, 3, 4 years ago. And so I think this is going to be an opportunity for a lot of buyers out there who have capital to go out there and who are good at underwriting, good at finding deals, who are hustling and working hard, have relationships like we do, to go out and take a lot of these deals, because the blood has just started dripping into the water. And I think it's going to get a lot worse as we see more debt expire, more CMBS loans expire and go into default, as well as these bridge loan terms start to expire and operators need to either refi or get out of the deal and cut their losses, which we've already really started to see tangibly. So thank you guys so much for tuning in today. I know that was a lot of information, but check out our report with all summaries of all the other reports that we took a look at and took into account for our analysis today. I hope that my outlook on the market, that what I'm seeing is valuable to you. There are comments and polls on whatever you're listening to. Please comment on them. Let me know your thoughts. Let me know what you thought of the episode. Let me know what you think of the commercial real estate market now, what your crystal ball is. Let's get a discussion going. Let's let people know that we are all participating in here. And I'm so curious to see what you guys think and interact with you. So anyway, again, my name is Corey Mortensen, and thank you so much for tuning into the latest episode of the Mastering Commercial Real Estate podcast. I look forward to giving you more value. Thank you.